Today we have Michael Gayed, portfolio manager of Tidal Financial Group. He's back with us to talk about his leading indicators for what's next in the economy and the stock markets, and of course, what happened overnight. Very interesting thing happened with some trades. Welcome back, Michael. Good to see you.
I'm glad the world is still spinning, David, and that you're the one leading us.
Well, according to your indicators, maybe not for long. We'll talk about that. What happened overnight? We got a huge spike up in the 2-year. This is big single bar seems to have come back down today. You actually was the one who brought this to my attention. I was sleeping, but it happened overnight, and this huge spike doesn't always happen. Can you make sense of this?
I mean, in short, no, I can't make sense of it at all. It was I put quite a few posts on it, and I was actually reposting things that people were trying to use to explain away what happened. But basically, there was this enormous spike in 2-year Treasury yields on several sources, TradingView and Investing.com and others. Some attribute it to some weird glitch, which now I'm having fun using that word. But there were some weird dynamics in that it looked like some trades actually did take place at those, 5.38% 2-year yields, which, by the way, didn't just happen on 2-year yields. It happened on, a lot of different durations on the Treasury side. It is it's weird. It didn't get any real coverage. People said it was an aberration. It's because Japan was closed. I don't know the real reason. I mean, it could be just one of those off things, but it is curious timing that happened with some of these news reports we're starting to see around economists within the Fed warning about disruptions in the Treasury market. I mean, those headlines literally just crossed a few days ago, and then suddenly you have something really weird happening on yields. Now, in fairness, stock futures did not respond, right, which probably suggests it's more of a data aberration more than anything else. But it is concerning that the most important asset in the world has aberrations in data. That seems something that really should make people maybe pause about the quality of data in general.
Well, we're gonna get back to treasuries and bonds. You said that it's the most important asset in the world, maybe for financial markets, but certainly not for the ordinary person who's not even invested. I would argue oil is probably right now the most important asset in the world. Correct me if you disagree on that on a more philosophical front, but let's just talk about oil for a minute. What is going on with the price? Over the last 3 months, I think a 40% increase in the last 3-4 months alone. And this is not, I don't hear a lot of concern from the people that I've been talking to. This has been partly responsible for driving up inflation. I'll let you comment on this.
Well, I'd argue, first of all, you're right on oil being one of the most important assets, and it's related to treasuries because if oil goes up, then treasury yields probably keep going up, and if treasury yields keep going up, credit card rates go up, and you got to pay for that oil credit card. So it all becomes, I think, interrelated. But yes, the oil move has been pretty remarkable. It's been, this kind of really steady upward march, which is another reason why I think the yield move was interesting from the perspective of cost push inflation and the link between oil yields and inflation expectations. I'm of the mindset that that's probably going to break pretty substantially, that the oil move is very temporary. And I'm saying that because if I'm right about a credit event, if it does happen in the short term, then that's going to bring everything down, oil included. But yes, it is a concern that you see oil again on this upward march, just as everyone's hoping the Fed pauses. Now, let's play it out. Let's say the oil stays here or continues to go higher. That probably is going to put further pressure on consumer spending, on consumer discretionary stocks. At some point, AI mania becomes more energy crisis fear, right? That transition starts to take place in the media. Again, not a base case, but it is still a concern, for most individuals that are outside of markets, and then, of course, most traders, because if inflation keeps rising with already elevated rates and all these zombie companies having to roll over their debt into higher rates next year, we're all in a lot of trouble.
Yeah, well, I've been getting reports that the oil price has gone up because of the end of the SPR releases. Can you just comment on that? Is that true?
Yeah, I mean, maybe. I mean, I had Dr. Anas Al-Haji on one of these spaces recently, a real energy oil expert. He's not terribly surprised by the move so far here in the second half. It could be related partially to that. It's also because of cuts and things that the IEA apparently are saying in terms of this is the peak of oil, so all the suppliers basically are just trying to cut to take advantage of the last gasp higher in prices Who knows? So it's unclear. But either way, I don't think it's demand driven, right? I mean, there's more going on in the oil market and the price action than the demand side. Because if the demand side were that robust, then you would be seeing consumer stocks do well, and that's not happening.
Bottom line is, what are you observing in the energy markets? This trend, $90 a barrel. Are we seeing $100 soon?
Possibly, and it's funny because it's, if you recall the last time we did, a conversation like this, right? I was talking about the reverse carry trade with Japan, and the whole thesis there was if oil were to keep rising against a depreciating yen, then oil denominated in yen forces the Bank of Japan to act. All right, and it seems like now that is getting to a point where that may end up being the case, right? And that creates all kinds of nasty unwinds, and the Mothra flaps its wings and creates the hurricane on a global margin call. So that thesis is still very much alive and well. So if oil does continue to rise, the risk is more around what happens to Japan's monetary policy and what happens to how much we pay at the pump.
I'm reading this interesting article from CNBC. By the way, markets are relatively unchanged this morning. I'm talking about the stock markets, S&P, NASDAQ, both flat as of around 11:20 Eastern time. This article from CNBC this morning, interesting. It says that economists think that interest rates around the world may have peaked. So the ECB hiked rates to 4%. Economists think that's the peak. The CME Fed Watch tool is pricing in one more rate hike by the end of the year from the Fed. And that's it. That's the terminal rate. And the pricing in a probability of a cut by next January. So what's your outlook? Is that correct for you?
I'd argue yields have peaked and not peaked at the same time. So, no, but I'm being very nuanced in that, because what I'm really addressing there is credit risk, corporate yields, right? So corporate yields probably are going to keep rising because at some point, if you have a credit event, spreads wide and default risk gets repriced into highly levered issuers. So those yields would rise because now you've got to factor in bankruptcy risk by these highly levered companies. Government yields probably, hopefully, I say hopefully purposely, hopefully have peaked, right? Because again, there's this really fascinating dynamic. You got a lot of speculative shorts that are playing this basis trade, making money off of long end yields rising. If that continues, we're all in a lot of trouble. It's like I keep going back to, it's crazy to me that people look at a chart on treasury yields, independent of duration, by the way, and they say, well, this is, they show a couple of squiggly lines, a couple of targets. It's like, no. You can't just apply that and not think about how that impacts the stock market, how it impacts mortgage rates, how it impacts housing, right? So I would argue that we should all hope that government yields have peaked, but that doesn't mean, so in other words, the economy should surprisingly be right. That doesn't mean that yields have peaked for the vast majority of companies.
Yeah, it's like short interest cat. It's like both places at the same time, low and high. But okay, just on that note, let's just do a true and false. All right, true or false? 10-year is going to hit 5% by the end of the year. We're at 4.3.
If I'll go qualify. If it's true, we're in a lot more trouble than we think. I think it's false, personally.
Wait, why would we be in a lot more trouble? Can we just explain your thesis here? Usually, correct me if I'm wrong, if the long end of the curve goes up, doesn't that signal confidence in the economy? That's why yields are going up?
It depends on oil, going back to that, inflation. And if it happens too quickly, it becomes a shock. The discussion around yields, and that's why the 2-year yield was why I was trying to highlight it, even though I myself admittedly was confused, as I said repeatedly on X. The issue isn't the level of yield; it's the speed of yields. I mean, that's ultimately what impacts risk assets. So if you're going to tell me it's going to be at 5% by end of year and it happens all in 1 week, that's nasty. If it happens, gradually, okay, maybe that's more manageable. But I'd be surprised if that happens, because I still think a credit event is much more likely than not that forces the flight to safety trade back into government debt.
Okay. You have a number of indicators in your that you follow, that you track regularly on your lead leg report, your award-winning lead leg report. By the way, if you click on the link down below, you can get 30% off on your subscription. Michael, tell us about, first of all, the gold lumber ratio, or the lumber to gold ratio. Historically, it's been, I'll let you comment on how it works, but historically, I believe it's been a pretty good leading indicator for risk on or risk off appetite, correct?
Yeah, and it's deceptively simple, right? Lumber is about housing and gold's about a flight to safety. So you compare the two to each other, and their movement tells you something about, on a go-forward basis, volatility conditions changing for risk assets. Right. By the way, that's not an opinion. That's based on pure data and pure facts, right? On average, when lumber is strong, volatility is lower. On average, when gold to lumber is strong, volatility is higher for stocks. Okay. So that's at least on a rolling 13-week basis now officially flipped. My own fund, Roro, which uses a different look back period, shorter, right, has been risk off in treasuries. Obviously, hasn't helped, right? Part of the pain point of all my funds has been still the failure of treasuries to counter equity volatility. So I think that is interesting because that this time around it's happening with home builders looking more and more weak. One of the great disconnects over the last year was that lumber kept on weakening as a key component of construction, but home builder stocks kept on strengthening. Now it looks like they're a little bit more in sync. So there could be some consistent messaging there as far as what it means for housing, which again should make sense given unemployment now potentially starting to pick up, the lagged effects of the fastest rate hike cycle in history impacting consumers, and now student loans repayments also kicking in, right, which has all kinds of impacts on housing demand. Okay, so there's that. What's now interesting is that that's also happening, the risk off side with lumber to gold. It's happening at the same time utilities are also giving a pretty sizable warning, right? Now, of the 5 papers I'm known for, which won these different awards, which are all anonymously submitted, which are available on socialscienceresearchnetwork.com, the first paper that won the 2014 Now Award focused on the utility sector, most boring frickin' sector of the stock market. And the finding is very, very simple. Utilities are the most bond-like sector of the stock market. You go back to the late 1920s when utilities are outperforming on a short-term basis the broader stock market. That's also a risk-off signal. There's defensive posturing that takes place. There's a feeling that demand for money is going to fall. And by the way, this is not something that's like magical. Plenty of very well-known legendary macro technicians who got a lot of big things right historically looked at the utility sector as one of the big tells for a cycle change. Last 8 trading days.
Well, just to clarify, you're looking at utilities relative to the S&P, right? That's that ratio in particular. Utilities going up by itself doesn't mean much. Is that correct?
Right. It's the up more or down less behavior. Okay. Especially if you see markets positive while defensive utilities are up more on a big day. Like that's actually like a historically a pretty big warning sign because it suggests that there's not real belief, by in quotes smart money. So utilities last 8 trading days have had a massive relative spread against the S&P. Now, on the one hand, you can argue that that's due, which I myself argued, because utilities were so oversold, massively underappreciated in terms of their movement. But at the same time, it's like, all right, that's happening in September with small caps week, with all these other dynamics taking place, with AI froth now coming out, as you can see that with NVIDIA. So I just wonder if the utilities movement also signaling risk off, combined with lumber to gold signaling risk off, combined with September and October being poor periods, if all that furthers the argument, I myself have been arguing that we're probably close to at least some kind of high risk period, right?
Okay, so we're entering high risk. But wait, I think you said earlier in the year when we conversed, I think a couple months ago, April, I believe, you mentioned that there could be a possibility of some sort of melt up by the end of the year. Have we already? Are you still sticking to that?
No, just to be clear, I think I even corrected on that video. It was January 9th or 10th. I said pre-election year, meltdown dynamics, but there's a credit event later in the year. And I laid all that out. So it's funny, because actually in April is when I started my first turn being more negative. I said 3rd week of April, you'd start a correction for the stock market. Here comes May, AI mania takes over. 7 sectors out of 10 for the S&P were down more than 4% in May. And I just turned more negative in my tone, even though my own strategies were rotating risk on, risk off because they're rules-based, independent of my tone and my view. No, I think the melt-up, you can argue, argument has largely happened and arguably only happened in a select number of stocks. If you look at small caps relative to large caps, they're lower than the COVID crash flows. I mean, there is some real serious weakness that's gone on beneath the surface that does not get enough play because everyone and their brother just thinks the market is 7 stocks.
Okay, well, let's talk about a market that's not 7 stocks. It's I'm talking about IWM, the Russell.
Yep.
2000. You tweeted something 2 days ago, and basically what it is pre-election years, the performances of the Russell 2000. You highlighted this year negative 2.65% down on the year, which again, big divergence for the S&P 500, driven up by the Magnificent 7 stocks. What are you trying to highlight with this table?
Yeah, so basically that looks at all pre-election years for the Russell 2000. Pre-election years because they tend to be the strongest of the presidential cycle. And then
the big difference, by the way, between the max pre-election year gain, which is 2019, 6%, and 1987. So yeah,
and that was just looking at the first 10 trading days of September. How small caps look this year in the first 2 weeks of September versus all other first 2 weeks of September in every other pre-election year. And I only showed that table because it's the second worst after 1987. Now, I've made this argument before. This is about path, right? So 1987 was a melt-up year. You had a Fed hiking rates in 1987. Then you had a crash. Then you had the Fed pivot. And the market still closed positive, and it was a pre-election year. I don't know if you're going to have the exact same type of dynamic, but my only point in showing that is that it's not impossible to think that something very sudden and sharp can happen in the very short term, as it did in 87. And it's a little eerie that small caps, have such poor performance after already being weak the bulk of the year relative to the S&P at the same juncture in the calendar when it was weaker slightly in 1987 before the Great Crash.
Correct me if I'm wrong, but are you suggesting that the Russell is oversold right now?
Well, this is the thing, right? Yes, there's no question Russell on a relative basis is oversold. If you're really going to be bullish, you probably want to be bullish on small caps. The thing is, as I've said many times before, markets crash from oversold levels. So this is the trick. This is why this is so challenging, right? Because, you can make an argument that there's not going to be a credit event, that small caps and all these other areas which are so bombed out are due to run, like defensive sectors, by the way. But at the same time, it's also where there's the highest degree of vulnerability.
Okay, I'm gonna try to pin you against the wall today. Just give us if you had to choose, would you say that the peaks have been already in for any index this year?
So historically, you go back to the 1920s. The S&P, using the backcasted index for the S&P, 8.3% of the time peaks in July of the year. So you look at all years. When did the peak of the year happen for equities? 8.3% of the time historically happens in July. Now, some people say that has to be 1 in 12. Ha, ha, ha. No, it has nothing to do with 1 in 12. It just so happens that it's 8.3%. 40% of the time, the S&P peaks in December. So it is true that historically markets do tend to drift higher into the end of the year. So the odds still favor the bulls in terms of the highs for the S&P still coming for the end of the year. But my point is it's not impossible. Now, again, I go back to there's so many divergences happening beneath the surface and so many high-risk things and so many, I'd argue, complacent, uneducated speculators that I'd probably argue that the peak for the S&P and the NASDAQ probably are in. I could be wrong, but at least 8% is not a very, very small probability.
We have to bring up this. By the way, I recommend everyone to follow Michael on X, formerly called Twitter. He's got some great tweets, very entertaining, very informative at the same time. If you want a good education at the same time as a good laugh, just follow his tweets. You've been tweeting.
And by the way, if you have low blood pressure and you want to raise your blood pressure, follow me. Because that's one thing that I'm very proud of is my effect on the human body.
Well, okay. There's that. One of the things I like about your tweet is that you're very open about how you feel about certain government officials and their views. For example, just an hour ago, you issued some strong language against what you feel is incorrect analysis by Janet Yellen. So this is what she said in a Reuters article. I don't see any signs that the economy is at a risk of a downturn. So she's noting that the U.S. economy is strong, the labor market's still strong, inflation was coming down. There's absolutely, by the way, inflation has been coming down. It's been ticking up since 3 months ago, so second uptick in a row. There's absolutely no reason for a shutdown. She's talking about a potential government shutdown. There's no need to stop the momentum at this point. Okay, I'll let you dissect what you just said. Yeah. There's no signs of an economy weakening, Michael. You and all the other bears are being overly dramatic, according to her.
The funny thing is, everything that you just said was from an article that was written in 2017 that she said all that. And it's funny because I hadn't actually framed it the way you just framed it, but everything she said in 2017, you could say now. Right, because it sounds like it was present, right?
That's true, yeah. Right. Just to clarify, she said this on Monday. She said the same thing 2017. Yeah, you're right.
Right, which was really hilarious about the whole thing. But it's kind of silly, right? It's like people listen to her and as if she knows what the future holds. It's not a critique on her. Nobody knows what tomorrow brings. But the fact that in 2017 she said we'll never see another financial crisis in our lifetime. You saw two, COVID, okay, which was a financial crisis, not just a health crisis. Oh, and by the way, for a moment in time, the regional bank crisis. It's like, come on. I mean, this is kind of silly, right? That people even talk about this stuff. But the broader point is like all these people that are in power, they have no idea what they're talking about, and
I understand.
They have no humility.
To be fair to her and other people before COVID, I mean, nobody predicted the pandemic or the effect of the lockdowns. But I get your point. Yeah,
right, and that's my point. It's like, markets surprise, life surprises, the world surprises, right? So, it's that complacency is what kills it, right? Is often what causes people to get into trouble. So. I'm not like a Yellen or Powell hater. I'm a hater of the arrogance of intellectuals who think they know what tomorrow brings, when time and time again all of their models end up being proven wrong, right?
So you think government officials who say things like that are potentially misleading investors to not be prepared for worst case scenarios?
I think the most powerful delusion is self-delusion. I think they are themselves deluding themselves, right? And I do think that investors should be concerned about risks. It's like none of this is like new. Like this whole dynamic with the Magnificent Seven, everyone's like, "Oh, this is gonna be fine. It's gonna continue." The last time you had concentration like this relative to small caps was 2021 when the whole bear market started. It's amazing to me how people just like totally have no attention span, even though something just happened recently. So my point is that all these gurus and all these policymakers, they're all just reacting and responding. They don't know what tomorrow brings. They often create the crisis that they end up being hailed as the ones that solve them, when in reality they're the cause to begin with.
Well, let's just brainstorm a few potential black swans. I know that's in itself an oxymoron because we can't predict black swans, but let's just, for the sake of argument, talk about some low probability tail risk events. So I'll let you give your ideas. I'm just thinking off the top of my head. First of all, there's a possibility that China could ban Apple. Maybe not tomorrow, maybe not next month, but down the line. That is going to wipe out a big chunk of Apple's market cap, and that's going to bring down the entire index just by default. Okay, so there's one. Another one is China itself. You talked about Japan. We haven't talked much about China. The housing market is a huge bubble. If that pops, when it pops, in some form or fashion, huge ramifications for the entire economy and consumer demand. China, real estate is the largest industry in China. Am I missing anything? What other potential downturns do you see?
Yeah, I mean, I think they're largely geopolitical ones, as you're kind of alluding to, right? I mean, that's the risk. And let's not forget we have a president and a presidential candidate who are old. I'll just leave it at that. Like, we just don't know. Right. And
well, that just means Kamala Harris will be president. So
yeah, but entering an election year just seems very messy, right? Like, I'm just saying, you don't know, right? That's my point. It's how the market will respond to that. Who the hell knows, right? But the point is, it's risk, right? It's just who knows what the reaction will be. But it becomes very messy into that situation, obviously, and horrific from a lot of perspectives. But yeah, to your point, it's like nobody knows what a black swan is. I still think the yen carry trade is the reversal of that is the big one, right? To kind of worry about the most, because now you are at the juncture where it's going to be a real problem, right? Now, there have been a lot of smart people that argue that you could see, going back to this point about the 2-year yield and whether it was real or not, but it kind of reinforces this idea of what if you had some real disruptions in the treasury market, like what we saw with the UK with gilts, right? So, and I floated that idea out before. It's like, well, maybe the credit event is treasuries themselves. Now, if that happens, treasuries would collapse, but then stocks and risk-on assets would collapse, and then that will cause a flight to safety back into treasuries. At least I think that's how the sequence could play out. But it goes back to when the most important asset in the world, what is supposed to be the most liquid and safest asset in the world, is acting like a crappy cryptocurrency in terms of the speed with which it's acting, and is acting as if there isn't liquidity. Like that seems like the ultimate real black swan surprise.
Right. Okay. Just rewind 10 seconds. Can you just walk us through the sequence of events once this credit collapse or credit event happens, from whatever catalyst that could be the catalyst? Which assets will go up? Which assets will go down?
Yeah. So if treasuries are the event, which they could be, right? I mean, meaning that's why I was so focused on it last night, because I put out this post and I said, if that is a real print on the 2-year treasury yield, I said the banks are done tomorrow. I said this last night, today on Monday, right? And people are like critiquing that. It's like, no, that's facts, right?
Sorry, what banks? Which banks are you referring to?
No, the entire financial sector, because their collateral is treasuries. So if you have a yield spike, that means the value of the collateral collapses, right, relative to all the liability and debt. You're talking about a complete freeze up of credit, right? So people saw that it sounded dramatic, but I was actually being very sincere because that's the cause and effect. Obviously, it didn't happen, right? Because the yields at least reprinted back to the way it should have been. But if you end up having some kind of real super spike in treasury yields, like we saw with the UK gilts, you're going to have treasury sell off. So all the bonds sell off very aggressively, yields spike. But then at some point, that has an impact on risk on assets because everything's predicated on risk-free rates. So if risk-free rates now have risk, then suddenly everything else sells off. If everything else then sells off, I think that creates then a flight to safety back into treasury. So it kind of solves itself in terms of just that idea that the Fed at the end of the day will do anything and everything to save the bond market, right? So more than stocks. So again, it's not a base case, right? But it's not impossible. I mean, if anything, the last year and a half, and I argue the last 3 years, we should all get used to things that nobody ever saw coming happening very regularly.
Why would a flight to safety necessarily just be treasuries? Do you see any other assets benefiting from this?
Yeah, probably gold, probably the dollar. Dollar, by the way, has been also signaling risk off, right, in its own appreciation. Utilities on a relative basis. I do think gold actually becomes really intriguing here. I even posted that a little bit earlier today. I said, gold this week. I think
you think gold's going to go up? Yeah.
Yeah, I think it's going to be a big week for gold. And I say that because if the Fed were to pause and there's other weird dynamics volatility-wise, I think you are probably going to have some interesting reallocations to gold as an alternative diversifier.
Is gold a good hedge against volatility, though? I'm just asking, on a broader level. Yeah. If you look at what happened this year, gold went up coincidentally with the equity markets going up at the same time. Same thing with 2020. And during big market crashes, which is the beginning of 2020, when lockdowns first happened, and 2008, when Lehman collapsed, gold goes down with the equities initially because you raise money when there's a fire sale, and gold is the first most liquid thing, closest cash equivalent to sell besides treasuries. Right, so it recovers afterwards, but it goes down. The coefficient, the correlation coefficient is still 1 during a sell-off.
It depends on the past. So usually there's a little nuance in there around the disposition effect. I mean, if you're going to have a sell-off, it's going to be primarily funded through the Magnificent Seven because people tend to sell winners before losers, and there aren't that many big winners. It's just the 7 mega cap names, which is why NVIDIA remains, without using the word, in big trouble just because it's gained so much. But the point about gold is that there is a link, at least in short-term periods from a path perspective, where money does flow into gold on a relative basis, holds better than equities. Doesn't necessarily tail off and last very much longer than a few weeks when it happens. This is just based on pure. Treasuries usually are the best place to be because usually when you have a flight to safety and high volatility, money goes into treasuries, and after the volatility subsides, there's still drift in momentum of yields going lower afterwards, which makes treasuries unique. Again, that hasn't happened really since 2020. Again, my hell for my own funds, right? But I was back to the 4 ways of playing risk off are the dollar, gold, utilities, and treasuries. Treasuries are the most undervalued of all those, but if treasuries are the credit event, maybe they need to have one last flush before it really kind of shines again.
I have to ask you about real estate. We've talked about this before. On your tweet, you retweeted this Bank of America strategy on real estate. So they're moving their U.S. real estate call to overweight. And this is an interesting view. So they're calling for the bottom, moving their view on real estate to overweight. The morning of our conference, they've been flagging real estate as the only sector pricing in a recession with positioning at Lehman levels. Now they're changing their stance, it seems. Interesting. What do you make of this?
Seems like someone needs exit liquidity.
Oh, boy.
No, I mean, it sounds like a conspiracy theory, but it's like, I mean, come on. I mean, I'd say that tongue in cheek, but it's like, really? Really? Okay, how much more do mortgage rates have to go until people get convinced that housing is in severe trouble? It's like, this is a long cycle. Right?
I think I've talked about this several times on my own show. Isn't it kind of ironic that mortgage rates have been going up at the same time? Isn't that the reason? Isn't high mortgage rates the reason home prices have still been relatively stable so far? Because the argument here, and please, argue against this if you like. The argument here is that because mortgage rates are high, it disincentivizes people to sell because you don't want to be financed at a higher rate if you locked in at a much lower rate before, right?
Right. Unless they're forced to sell because the yield curve warning of recession ends up being right, unemployment spikes, and then people say, you know what, I can no longer finance, independent of the low mortgage rate, my second, third, fourth, and fifth Airbnb home because suddenly it's not getting rented out. Right. I mean, like, and that then sets comps for broader neighborhoods. So it's complicated like everything else. I've been obviously very wrong on the idea that housing is in trouble, right? It's reaccelerated, you can argue, because of the wealth effect from the stock market, right? Independent people, because people are like, you know what? Mortgage rates are high, but hey, you know what? I'm making a ton of money in my Nvidia call, so let me go YOLO some house, even though mortgage rates are 7.5%, 8%. Okay, well, good luck with that lasting if you have any kind of a real lasting correction or collapse in risk on equities, which again would happen with a credit event. It's like all this stuff gets resolved. All these narratives get resolved with one thing and one thing only: fear. It's always how it plays out. Inventory gets solved with fear. Overvaluation gets solved with fear. Generational buys occur after fear. We're not there yet, but I think we're close.
Well, okay, so I want to bring this to your attention. You probably already know this already, but wealth by wealth percentile group. So the Federal Reserve, if you go on the Federal Reserve website, for anyone listening right now, distribution of household wealth in the U.S. since 1989. Just Google that. You'll get a chart, and what this chart shows is the level of wealth by the wealth percentile group. And so what you see is the top 1%. Top 10%, top 1%, and the top 0.1%, they hold the majority of the wealth in the U.S., obviously, and their wealth has been going up this year proportional to the rise in markets. So you see real estate going up, you see equity markets going up. The bottom 50%, which has held $40.8 trillion in net wealth in Q1 2022, is now holding only 40.19 trillion, so slightly down. So while the rich are getting richer, the poor are getting poorer, especially if you adjust for inflation. What are the implications for the economy?
First of all, that sounds bullish as hell for the metaverse, because everyone is going to want to escape the real life and get rich in the digital one. Which, by the way, is something I floated out back there. It's like, it was curious to me that everyone's focused on the metaverse. That's like, how do you distract the public from the fact that the top 1% are just taking it all away from them? You do it, with goggles, right? I think is what you can argue. Not that surprising, right? I mean, it's effective QE.
But isn't the argument here, Michael, that the wealthy getting wealthier, they're driving consumer demand. They're driving advanced retail sales. That's why we see nominal numbers going up. They're driving continuous demand for maybe risk assets. It feeds on itself. They're driving perhaps more investments into real estate, keep propping up the markets. As long as that segment still has wealth, we're fine, right? The real economy could suffer, actual ordinary Americans could suffer, but actual demand into risk assets and discretionary spending driven by wealthy people getting wealthier, that's still going to be fine.
Maybe, although, and in fairness, I have not looked at this in a while, but I'm pretty sure if you were to look at wealth disparity in the lead up to the Great Crash of 1929, you'd probably see a similar spread. My point is that, it goes back to how do you solve the wealth gap? By eroding wealth, right? By hitting risk assets, right? And look, every society always has some kind of differential that is wide between the very rich and the very poor. The last thing any society wants is for that to get too wide, because that's when revolution tends to take place. Not that I'm saying that that's going to happen, obviously, but my point is, that's the history of civilization. So the gap gets wider. People get more and more apathetic. People get more and more angry, and blood pressure rises independent of my posts. Because at the end of the day, everyone's frustrated and nobody can afford anything.
Right. Bottom line, then, what are you doing with your own funds right now?
So, as I always emphasize, my funds are rules-based. So, independent of my own thinking, right? I design them, I develop them. Funds are very expensive to bring to market. They all have had a brutal time, and they've had a brutal time because of the opportunity set. My mutual fund has unfortunately really gotten hit this year and the last 2.5 years. Because it plays small caps and emerging markets with treasuries, risk on, small, emerging, terrible places to be. Doesn't matter how good of a trader you are. If the tailwind is not there for your opportunity set, it doesn't matter, right? So all my funds have had our time because they all rely, from a rules-based perspective, on treasuries to play defense. Now, that may, I hope, be the reason why they start to come back. Right now, all the signals are saying risk off. All of them are saying favor treasuries over equities in the short term. if I'm right about a credit event, assuming it's not treasuries, which again, would hurt me. That's the thing about this. It's like if treasuries are the credit event, it's going to hurt me too with these funds. But if the flight to safety trade does reassert, treasuries come back, and it's very possible that hopefully I come out of the nasty drawdown I've had. I'm the first one to be open and honest and saying my strategies have had a very hard time because environments of pure risk on, pure large caps result in tremendous whipsaws for anything that's active and tactical. So the environment that I have suffered through, and I say that word purposely, the last 2 years, has been the worst possible environment for my own strategies and funds, and you can see it in the performance. That doesn't mean that the analysis is wrong. It just means the cycle has to come their way. Right now, it looks like everything's saying defense. Could be wrong, right? But if it's right, the payoff for being defensive at the right time will be everything.
Is that how you're positioned right now? Can you just give us maybe an overview of one of your funds and how you're allocated in terms of overweight, underweight?
Roro and Jojo, when they position risk off, Roro's my risk on, risk off fund. Jojo's the bond fund, junk on, junk off. They go all in treasuries, long duration. So they're both in the same long duration treasury position right now.
Okay. All right. Makes sense, given your thesis. Now, you wrote an article recently. I'm just going to comment on this before we go. Emerging markets may likely be winners in a stock market crash. I assume you mean a U.S. stock market crash?
Yeah, maybe after the crash. Right.
Okay. So what's your logic here?
One of the main reasons why emerging markets have been such a brutal place to allocate to is a strengthening dollar. Okay. So if you have a credit event or crash in equities, which, again, I'm not saying it's a guarantee, folks, when I say credit event, but I think it's a much higher probability than people realize, right? Conditions do favor it from my vantage point. So if you have a real collapse in risk on assets, what does the dollar do? Probably has a super spike, right? Okay, now, after that, what's going to happen? What always happens? The policymakers step in. They reliquefy, which probably means what? It means the dollar then goes down, which would be a tailwind for emerging markets because of the currency adjustment. So when I say emerging markets, my whole thesis, and I said this back in June, right? I said, I suspect you're going to have a stupid move up in small caps in the short term, which didn't really happen. Okay. Then I said, you're going to have a credit event. And then after that, emerging markets have a big run. So we'll see if I'm going to be right about 2 and 3 there. But if you have a real collapse, dollar spikes. After that collapse, dollar starts to weaken aggressively. That should provide some real momentum finally for emerging markets. Whether or not you get out of the 10-year plus sideways nonsense, which has been hellish for my mutual fund, ATAX, that remains to be seen.
Okay. Well, let's. I'm going to end here. What would change your mind on your stance? In other words, you're defensive right now in terms of your outlook and your actual positioning. What would make you more pro-cyclical?
Well, you need to have cyclical momentum. I mean, this is the thing which is, I think, missed by people that try to track my posts. Those that read the actual lead lag report get this because it's much more, involves much more serious than the persona that's on Twitter and X. But you need to have intermarket trends tell you that now's the time to be risk on. So what does that mean? It means small caps outperforming and leading, not whipsawing. It means emerging markets outperforming and leading as a cyclical play. It means broadening of NASDAQ strength. Because right now, if you look at the percentage of stocks in the NASDAQ composite trading above their relative 200-day moving average, it's like 36% or so, like in the low 30% last I checked. So even within the NASDAQ, strong tech plays are not really looking that strong again. So you need to have a real broadening out of momentum, not any more of this concentration nonsense, which has fooled everybody into thinking it's a strong market when in reality it's idiosyncratic risk. I'm not discounting that can't happen. That can unequivocally happen. I just don't think it's likely in the short term.
I'm just going to push back slightly, okay? So a contrarian might say, now is the time to buy something like a small cap. Why wait for it to go up? Wait for it to whipsaw and consolidate. That's the time to get in. How would you respond?
Depends on time frame. Right, so if you're very long term, yes. So look, I've done some slightly interesting on this. Small caps actually end up being much better than large caps in election years. Which is next year, right? So they end up actually being the winner from a presidential cycle perspective in election years more than large caps. So yeah, if your time frame is next year or into the year after, yeah, sure, why not? Why even bother trying to wait? Just try and play it here. But my world is much more short term and intermediate term. So from that perspective, I wouldn't touch them here until there's real persistent momentum. You got to see the whites of the eyes of strength, and they're not there yet.
Do you ever get FOMO as an investor? Do people ever come to you and say, how do you feel about missing out on NVIDIA? How do you feel about missing out on Apple? That was asked to Warren Buffett, by the way, years ago. A reporter asked him, how do you feel about missing out on Apple? This was before Berkshire Hathaway bought Apple. And he said, well, I don't regret not being on a boat that I missed because I didn't feel confident enough to captain that boat. But that was his answer. What's yours?
Yeah, I mean, I don't disagree with that mindset. Listen, I mean, my strategies that I launch, as an entrepreneur of ATAX, Roro, and Jojo, they're rules based. So there are plenty of times when a rotation happens, and I'm like, like I don't want, like I feel like that's not the right move. But you're supposed to follow what the strategy signals do as a PM. That's what a whole rules based approach is. So yeah, of course, I think FOMO is a very natural feeling. By the way, Warren Buffett has had 2 times in his career where he was down 50%, and yet he's still considered the greatest investor of all time. So I always like to stress that point because the reality is there's FOMO and then there's drawdowns. Everybody goes through drawdowns. Everybody's going to feel drawdowns. Everybody goes through FOMO. Everybody's going to feel FOMO. What matters is the cycle coming your way and sticking to a strategy long enough for that to be the case. So yeah, of course I have FOMO. I think if you're human, you have to have FOMO. But that's also why I'm a big fan of rules-based approaches to take the human element out.
If you're actually watching this, go subscribe to Michael's Twitter, X. Go follow him and follow his work there, and follow him on the Lead Lag Report. What's different? Let's just close on this note. What's different about your work on Lead Lag versus, let's say, just what you post on Twitter?
Well, a lot less cursing and a lot less of the silliness. I mean, I keep going back to, look, I pivoted towards this persona, which is loud and aggressive on X because it works. It gets engagement. That's the reality. And because my funds went through such a nasty drawdown in the last year and a half, what else am I going to do to try to grow the audience and keep the eyeballs and eardrums on me? Because anyway, look at my own funds would say, why would I listen to this guy? Right? So I had to pivot, right? Until the cycle comes my way. That's how I ended up getting more of a reach on social media, despite all things saying I shouldn't have the kind of reach I have today because of what's happened to my own funds. Because
did your follower count, I'm just curious, did your followers count grow after you started blogging people, or go down?
Yes. No.
I think it goes down,
that's
right?
That's a whole other fascinating dynamic. I block people and their ancestors when they attack or mock me on social media. And oddly enough, the followers go up. But the point is, like, the Lead Lag Report is a much more serious research, right?
Yeah, I understand.
It's a much more involved, complex, dedicated towards real, deeper thought. And I always stress, I have a large number of subscribers, paying subscribers on Lead Lag Report. I cannot tell the future better than anybody else. All I can tell anybody is the conditions and try to get people to think differently. And I think that those that are paying subscribers respect that. I'm not some guy that's out there saying, make 10x your money from this microcap stock.
Or specifically, what do you write about?
So risk signals, which is consistent with the white papers that won these different awards going back to 2014, high yield ideas, sector outlooks, macro observations, global thoughts. So it's a much more complex and complete way of trying to get a deeper understanding of the way that I myself am looking at the world. And again, I'm wrong all the time. Everyone is right and wrong all the time. The one thing that I'm a big fan of is being open and honest and having the integrity and consistency of the thought process. Right? And I think my thought process will be right on this credit event. If I'm wrong, I will never apologize for warning people to slow down when it's raining.
Okay, well, I think you're front running the Black Friday sales because there's a 30% off right now. So click on that link below to access this Lead Lag Report that Michael's talking about. Thank you very much for your time today. We'll catch up again soon. Appreciate it.
You remain the man. I appreciate you, David.
Well, I just tried my best. Thank you for enlightening my audience as well as yours. And thank you for watching. Don't forget to subscribe to Michael's links down below. And don't forget to like and comment and follow me as well. Thank you.